Now in this class we begin with DuPont analysis for understanding return on equity. So first thing what I want you to do is write this heading, DuPont analysis for understanding return on equity. Now what are we exactly targeting in this analysis? This is part of your topic financial analysis technique, which comes under ratio analysis. So here we are not going to learn any new ratio at all. We will be dealing with all the ratios that you have already learnt. Of course, not all the ratios, I mean some relevant connecting ratios, ratios which can connect with return on equity. So DuPont analysis typically talks about breaking up that very important ratio, that is return on equity, into various components. Means the product of those various ratios will finally result into return on equity. And this is beautifully done, and it is classified into two approaches. The original DuPont analysis came with a 3-term approach. So 3 terms, when you multiply to one another, that means the product of the 3 terms will give you the return on equity. And later on, this was further broken down into a 5-step approach. So we will first learn the 3-step approach and then the 5-step approach. What I really want from you all, don't just mechanically mug it up, logically understand the whole thing. So I'm sure you would have written this heading by far, that is DuPont analysis for understanding return on equity. So after writing this heading, let us move ahead and write something further in this. The DuPont system of analysis is an approach that can be used to analyze the return on equity. It breaks down ROE, that is return on equity, into a function of different ratios, so an analyst can see the impact of leverage, profit margins and turnover on the return on equity and hence on the shareholders' returns. There are 2 main variants of the DuPont system. The first one, the original 3-part approach, and the second one is the extended 5-part approach. So let us do one thing. Let us first write up this whole content and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead, and now we talk about the original 3-part approach. So let me remind you, the ratio, very important ratio, return on equity, is determined as net income divided by average equity. So net income is basically the net profit after tax, and this is the average shareholders funds, means shareholders funds at the beginning and shareholders funds at the end, average of the two. So when you are determining this particular ratio, return on equity, what does this resemble? It resembles that the shareholders, what return they could generate on the investments that they have made, collectively all shareholders taken together. So when we talk about equity, it basically represents the shareholders funds, which will include the share capital and all the components of retained earnings, and this you have to take as an average. And generally what we do not have the details of all the movement of equity throughout the year. So we take the equity at the beginning and equity at the end, and we just take the average of these 2 values. So average equity is the denominator and revenue is generated throughout the year, and hence net income is also generated throughout the year. So net income, that represents the net profit attributable to the shareholders, that divided by the average equity will give you return on equity. Now what do? We break up this ratio into first two important fragments. Let me show you how to do that. Look at this. Net income divided by average equity. You can break it up as net income divided by average total assets. Now use your simple common sense. In the denominator we wanted average equity, but instead of average equity we have taken the average total assets. If you have taken the average total assets but eventually you want average equity, in the next term which you are multiplying, whatever you have placed over here as denominator, same thing you place over here in the next term as a numerator, that is average total assets and divided by average equity. So what will happen eventually, this average total assets in the numerator of this term and average total assets in the denominator of this term will get cancelled out, and what you will get eventually is net income divided by average equity. So that is what matching with the left hand side of the equation. Now once you have done this, you can identify that net income divided by average equity is what we call as return on equity, ROE, whereas net income divided by average total assets is the return on assets, ROA. And then this ratio, average total assets divided by average equity, is the financial leverage. Keep in mind one thing, I have told you very clearly in the class as well, that degree of financial leverage is different from financial leverage. Degree of financial leverage is measured by taking EBIT divided by EBT. That's a different ratio. We call that as DFL, degree of financial leverage. Whereas typically financial leverage, it indicates average total assets divided by average equity. So we can finally identify that return on equity is broken down into product of these two ratios, that is return on assets multiplied by financial leverage. So we were talking about three terms, but first we have initiated with breaking down the return on equity into just two terms. Gradually we are going to bring one more term and couple of more ratios in the equation to break it into three-part equation. But let's not rush towards it, let's move gradually over there. So first take note of this entire thing what you find on screen. Alright friends, I'm sure you have completed writing this whole thing. So now let us further explore into our analysis. Look at this one. This ratio is return on asset, right? Now what I'm doing, if I can break up this return on asset into two fragments where the product of those two ratios will be return on assets. How? We use the intermediary value as revenue, that is the sales. So if I divide net income not by average total assets, if I divide the net income by the revenue, so it will be net income, that is net profit after tax, divided by revenue, that is your sales. So net profit after tax divided by sales will give you what? Net profit margin, correct, or net profit ratio. And then because we divided it by sales instead of average total assets, in the next term we are going to multiply the total revenue, that is your total sales, and divided by average total assets. So eventually you will be still getting the same. Let me show that on screen so that you get crystal clear understanding. So net income divided by average total assets, that will be the return on assets. We are breaking down this into net income divided by revenue into revenue divided by average total assets. So mathematically, revenue here in the denominator of this term and revenue over here in the numerator of the last term will get cancelled out against each other, and what you get is net income divided by average total assets, which is matching with the ratio on the left hand side. So left hand side we know that this ratio is return on asset, ROA, whereas the ratio on the right hand side, this one, this is the net income by revenue ratio, which we identify as a net profit margin, and the last ratio over here, revenue by average total assets is the total assets turnover ratio. We can simply call it as assets turnover, correct? Total assets turnover ratio is a proper name of that ratio, but when we generally speak, we can just call it as assets turnover. It indirectly means the same thing, that is total assets turnover ratio. So what we could do in this equation, we could break down return on asset into two terms, that is product of these two ratios. Which two ratios? Net profit margin and assets turnover is going to give you the return on asset. And earlier equation that we have learned, it was return on equity, which was return on asset into financial leverage. So logically we are cracking this term return on equity, which is return on assets into financial leverage, and return on asset itself over here, as explained, it is net profit margin into assets turnover. So return on equity will be net profit margin into assets turnover into financial leverage. So don't rush with anything. Please carefully take note of this entire thing, and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and take up examples for understanding the same. So let's begin with example number 1. The following information is extracted from the financial statements of Alpha Limited for the year 2025. Net income 18,000, average total assets 180,000, average equity 72,000, and revenue 360,000. Required. Using the above information, calculate the following, that is net profit margin, assets turnover ratio, financial leverage, and return on equity. And of course at the end we are not just going to compute these four, we are going to analyze the DuPont part. So what we have learned in the initial chain, if we try to put this by calculation, what we will get, net profit margin will be net income divided by revenue, that will be 0.05 or 5%. Assets turnover will be revenue divided by average total assets, and that will be 360,000 divided by 180,000, that comes to 2 times. Financial leverage will be average total assets divided by average equity, that will be 180,000 divided by 72,000, and that will be 2.5 times. So please write up these calculations and then I take you ahead. Alright friends, once we have completed writing this whole thing, let us move ahead, and as we have learnt, we will compute first the return on equity, that will be net income divided by average equity, and that is 18,000 divided by 72,000, and that comes to 0.25 or 25%. So if we go with the original 3-part approach for DuPont analysis, we would say return on equity is a product of net profit margin into assets turnover into financial leverage, and that will be 0.05 into 2 times into 2.5 times, and when we multiply these three, what we get is 0.25 or 25%. So please write up this calculation and analysis, and that will be end of this example. Alright friends, I am sure you have completed writing this whole thing. Now we have just discussed the original 3-part DuPont equation, that is this one. If we go to the extended DuPont analysis, look at this equation. We are going to further break up the net profit margin into multiple components. Net profit margin itself is a product of 3 terms, that will be tax burden, interest burden, and the EBIT margin. So you take EBIT margin. To that you multiply interest burden and tax burden, you will be getting the net profit margin. So net profit margin, if you further break down into those three components, that will be the extended form. So actually, if I read the whole extended form of return on equity, instead of net profit margin, I will say EBIT margin multiplied by interest burden multiplied by tax burden. That was basically the breakup of net profit margin. The product of those three will make it to net profit margin, and to that you multiply asset turnover and financial leverage, you will be getting the return on equity. So let us first focus on just breaking up the net profit margin, and then we go for the whole equation for the 5-point. So extended 5-way DuPont equation. This takes net profit margin and breaks it down further. The first term in the 3-part DuPont, that was the net profit margin, has been decomposed in 3 terms. Which 3 terms? Net profit margin is now net income divided by EBT, then EBT divided by EBIT, and EBIT divided by revenue. Now net income divided by EBT, this is basically the tax burden. Now why it is called tax burden, you will never understand unless you have taken up a small example. Let's say that earnings before tax was $10,000. Okay, earnings before tax was $10,000 and 30% is the tax rate. 30% is the tax rate. So earning before tax $10,000. On that, when you apply 30% tax amount will be $3,000, and the net income after tax will be $7,000. So when you compute this ratio, net income divided by EBT, it will be 7,000 divided by 10,000. Correct? 7,000 divided by 10,000 will give you 0.7. That 0.7 is nothing but 1 minus tax rate, because tax rate was 30%. So 1 minus 0.3 is going to give you 0.7. So understand one thing, the higher the tax rate, the lower will be this ratio. Correct? Higher the tax rate, the lower will be this ratio. As a result, we can get an idea of how much is the burden of tax depending upon this particular ratio. In the similar style, we can take the next ratio as EBT divided by EBIT, and this is called interest burden, because again if you look into, the numerator is after interest and the denominator is before interest. The way in this first term it was after tax divided by before tax profit, this is after interest divided by before interest profit. So after interest profit is nothing but EBT, and before interest profit is the operating profit, that is EBIT. So EBT divided by EBIT is the interest burden, and EBIT divided by revenue is the EBIT margin or the operating profit margin. So what I want you all to do, I want you all to take note of this whole thing, and then we move ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and take up the next example, that is example number 2. It says the following information is extracted from the financial statements of NJ Limited for the year 2025. Income statement is given in dollars, revenue 80,000, cost of goods sold 32,000, so gross profit will be 48,000. Operating expenses 24,000, so earnings before interest and tax will be 24,000. Interest is 8,000, so earnings before taxes will be 16,000. Tax at 30% is 4,800, so net income will be 11,200. Now the later part of the example further says, based on the above data, calculate the following components and use the same for DuPont analysis. So you have net profit margin, tax burden, interest burden, EBIT margin, and verify the net profit margin using the DuPont chain. So actually speaking, we don't have information about the return on equity over here. That means the detailed analysis, the whole thing cannot be done. You don't have information about total assets, you don't have information about equity. Because of these missing information, the whole DuPont analysis cannot be made. So question is very, very specific. It is asking you to verify the net profit margin using the DuPont chain. So they are just asking you the breakup of the net profit margin into three components: tax burden, interest burden, and EBIT margin. So what we have just learned some time back, we can apply that over here. So let's begin with the solution to this example. And in your solution, you will start with the calculation net profit margin, that is net income divided by revenue, and that will be 14%, 0.14 or 14%. Tax burden will be net income divided by EBT. One thing is very clear, because the tax rate is 30%, the tax burden will be 70%. That means the tax burden that resembles 1 minus tax rate will be 70%, because tax rate is 30%. Now interest burden will be EBT divided by EBIT, and that will be 16,000 divided by 24,000, and that will be 0.6667 or 66.67%. And operating margin or EBIT margin will be EBIT divided by revenue, that is 24,000 divided by 80,000, that comes to 0.3 or 30%. So let's do one thing. Let's first write up these calculations and then I take you ahead. Alright friends, once we have completed writing these calculations, let us move ahead and take up the next one. So DuPont chain, net profit margin will be broken down into three components. So product of these three components will be just matching with the net profit margin, and that will be tax burden, interest burden, and EBIT margin. Tax burden was 70%, interest burden was 66.67%, and then the EBIT margin is 30%. So when you multiply these three components, that is tax burden, interest burden, and EBIT margin, you are going to get the product of these three exactly matching with 14%, which was the net profit margin. So please write up this small DuPont chain, that was just not the whole chain but the breakup of the net profit margin, and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead, and now what we do is we bring up the whole extended DuPont chain. So if you talk about the extended DuPont chain, the 5-part DuPont chain, where the first ratio that you have used was net profit margin, which was multiplied to return on asset and then multiplied to financial leverage. Now instead of net profit margin, we are going to have these three ratios. So product of these three ratios, which will eventually result into net profit margin, when that multiplied to return on assets and financial leverage, it will ultimately match with return on equity. So what I am displaying over here, be careful about it. The extended 5-way DuPont equation, it takes the net profit margin and breaks it down further. So return on equity will be the multiplication of these 5 ratios. Net income divided by EBT, that is the tax burden. EBT divided by EBIT is the interest burden. EBIT divided by revenue is the EBIT margin. Revenue divided by average assets will be the total asset turnover ratio, and then finally average assets divided by average equity will be the financial leverage. So when you finally arrive at the equation of ROE, it is product of these 5 components. So let us take our time to write up the whole thing, and then I take you ahead.